again. I'm being told there was no audio on the first attempt. Let's go back into it. Let's try this again. Gotta love technology. All right, hopefully this one will work better. But look, this isn't really about Zion's and Western Alliance. It's not really about the two banks that came up yesterday, nor is it really about the market reaction to it, though that is an important part of it too. What we're seeing is it's the common thread that is emerging, not just from Zion's and Western Alliance, but also First Brands and Tricolor. We keep coming back to the same things over and over and over again, which means it fits within the overall macroeconomic as well as monetary background that we keep coming back to over and over again, the common thread with it. And it's not fraud. Fraud is basically the way that everybody's trying to downplay this issue with collateral. That's what keeps coming up over and over again, is the fact that there is questions about collateral. So starting with what happened yesterday, Zion's and Western Alliance, focusing first on Zion. Zion's reported that it had given a couple of investment funds named Cantor some revolving credit facilities a couple of years ago that Cantor was using to borrow funds from. They're borrowing from Zion's and Western Alliance in order to get this, commercial real estate mortgages. But that's not even really the problem here. These are asset-backed securities. They're all securitized and everything else. But what's been uncovered apparently is that while Zion's Bank thought it was given the terms of first priority for all the collateral, what they found out that instead was that many of the notes were transferred to other entities that had already been foreclosed on or were about to be. So understand what that means. So Zion's Bank was giving a revolving credit line to these investment funds named Cantor with the idea that they were secured by collateral. And you can also tell, again, this is the bigger picture stuff. You can also tell what happened here. Over the last several years, everybody was in a rush to book all of these deals. Everybody, cut corners and shortcuts. The bankers brought in all of these loans. They did the revolving credit facilities. They had pledged collateral. They had all the paperwork. They had all the documents. They never really looked all that carefully at them because they were just booking deals, getting deals done. Get it done. Put all that stuff in the drawer, and we'd never need it anyway because Jay Powell said the economy is perfect and just fine. But instead, what happened was, now all of a sudden we're seeing questions really start to arise. Is the economy just fine? Everybody's taking a second look and found that there was a lot of shortcuts that were taken. There was not enough due diligence undertaken. And there's been a lot of too much gray area and ambiguity that has allowed, plus the pressure of the bad economic climate that has allowed and forced and incentivized some of these increasingly distressed funds and companies like First Brands to take advantage of those cut corners and to repledge collateral, just trying to stay alive and stay afloat a little bit longer as everything seems to start to turn against them. That's what the cockroaches that Jamie Dimon talked about a couple of days ago. That's really the cockroaches. That's what he really meant, was that we're going to see more of these start to pop up because we all know that's the case. We all know there was a huge level of stupidity in the marketplace, especially where it comes to shadow banks and private credit over the last several years, where everybody was utterly convinced there was no downside because Jay Powell said so. And so everybody just said, oh, I've got the collateral pledge. What do I need to actually verify it for? I've got the documentation. We'll never need it to begin with. It's just there as sort of a formality, only to find out it was not just there. And understand how big of a deal this is. You've given a revolving credit line to a relatively risky project on the idea that it's secure, that it has collateral, that if this risky idea does end up blowing up over there because they're wrong about a whole bunch of things, it doesn't matter for you because you're protected. You have the collateral available. They default on the loan, no problem. You seize the loans that they pledged as collateral, you sell them, hopefully you get most of your money back. You're reasonably sure that you're probably over collateralized. It's just a formality in that process. But if you come to find out that they did do a bunch of stupid stuff over there, as we're seeing with foreclosures in their portfolio, they did do a bunch of stupid stuff, and then you go to find the collateral and say, let's take a look at where it is, and they say, oh, by the way, we already pledged it to somebody else, suddenly you realize you were never secured to begin with. Now, if this was just Zions Bank, you'd say, okay, you know, there's a lot of dumb stuff that happens. It's a very messy world and very messy marketplace. We don't want to put too much into it. But we keep seeing this over and over and over again, and everything that's been coming up more recently. As the Wall Street Journal reported, Western Alliance was involved in the same way, same problem. The collateralized arrangements that they thought they had that were relatively secure because of the collateral end up being not secured at all because the collateral was used someplace else. And there was, with the announcement yesterday, there was a very substantial knee-jerk reaction all across the marketplace because it's not just about these two relatively, I mean, they're sizable U.S. regional banks, but these are not huge losses. They're relatively sizable banks, but in terms of the entire system, this is not a huge deal. But people can start to get the sense, first of all, there's more to this story here. And second of all, we keep seeing the same problem. They keep calling it fraud, which technically it is, but it's actually about questions over collateral. Collateral being misused and abused, which is a huge deal. Collateral is what makes the entire financial system and really the entire Eurodollar world able to run. You take away the soundness and trust in collateral, and suddenly everything changes. Everything changes, and that would be under the best of circumstances, benign circumstances. We don't have benign circumstances, which plays into everything, including why there was such a major shock reaction to what otherwise would have been just a couple of little news items, nothing big at all. So Zions and Western Alliance, this is not really about them. It's about two more cockroaches that have scurried out that say the same thing, fraud, which is really about questions and collateral. So the banking index was down pretty sharply, though it's recovering today, like a lot of markets are. But in the short run, the knee-jerk reaction, the violent knee-jerk reaction is indicative of everybody being on edge, everybody being anxious. Like I said, because it isn't just those two. Those two are just the latest. You go back to Tricolor. Tricolor kind of kicked this off earlier in September. They saw the same thing. It wasn't just subprime auto lenders who did a bunch of stupid stuff and therefore, okay, credit problems, that's the end of it. Instead, warehouse lenders uncovered what they're calling alleged fraud, but it was the same thing, double pledging of collateral. So you have these firms that are getting into trouble, and instead of respecting the boundaries of collateral, they seem to be, as a sort of a survival tactic, doing things that they're not supposed to do in ways that they're not supposed to do, which is creating more than just a mess for these individual firms. And it was the same thing in First Brands as well. It wasn't just Tricolor, it's not just Zions and Western Alliance. First Brands, they had pledged inventory as collateral for financing arrangements, and suddenly they were supposed to be pledged to an ABS facility, and then they got pledged to other places. They were doing the same thing. And so you can understand why participants, especially regulated banks, all across the country, all across the world really, are saying, we didn't care about all this stuff when we thought everything was fine, but now that we're starting to see that everything's not fine, maybe we need to start taking a second and third look. Now, we don't know whether that's what provoked Zions and Western Alliance to do what they did, but it's not a big leap, and it's a pretty reasonable suspicion to think that they did this because they saw what happened with Tricolor and First Brands and said, uh-oh, we need to take a second look at what we hope we're not going to find, and actually found the same thing over and over again. So it's a very clear change in climate, a very clear change from, okay, we just have a bunch of paperwork, we don't really need to look at it, to, holy crap, we need to scrutinize, and we need to take a second look at everything because this problem keeps coming up over and over again. And with the macroeconomic and business climate being what it is, if we're not right on top of our collateral, how many more First Brands and how many more Cantors will be out there that will try to take advantage of the looseness in the standards and in the documentation and the monitoring and everything else in order to just try to stay alive a little bit longer? It's about the questions that are building in collateral because we're seeing this thing repeat a little too often for everybody to be comfortable. And in the climate, which I keep referring to, it makes perfect sense. And that climate really goes back to, as I talked about in our webinar a couple of days ago, that webinar does go back to March of 2023. As far as the mainstream goes, Jay Powell won the banking battle by instituting the bank term funding program. The Federal Reserve performed performed in exemplary fashion. The banking crisis of 2023 was just left behind as a little footnote in economic history that everybody's largely forgotten about. Well, everybody in the mainstream, everybody at central bank levels, everybody in the financial media, the markets have not forgotten about the banking crisis in 2023. It's not just the Swiss bank, which makes sense given Credit Suisse's involvement, which nobody ever mentions that one as well. But you see it in the German curve, and you even see it in US Treasuries. Same thing. The banking crisis in 2023 was the marketplace seeing and saying and recognizing what we're starting to see now. What the markets were saying is this is the final nail in the recovery narrative, because what the banking crisis uncovered was a lot of stupid stuff that was likely to be allowed to continue to get stupid over the next however long it would be, and that eventually all of this stuff was going to come back to bite everyone. There would be longer run consequences to what we saw in 2023. And now we're starting to see them pick back up as the forgot how to grow economy starts to remember a lot. The forgot how to hire economy starts to remember how to fire, which is the biggest part of all of this from the macroeconomic side, as I'll get to in just a second here. But over the last several years, the bond market has been warning about the eventual consequences in the banking sector and credit system. Not necessarily a replay of 2008, but that there was a whole bunch of stupid taking place in the banking sector that eventually was going to become what we see. All it really needed was a weak enough macroeconomic background to trigger some of the worst aspects of a lot of credit stupidity and risk-taking, especially among private credit and shadow banks, which we've been talking about for the last really year and a half more seriously. And that's why you keep seeing the same pattern in the bond market all over the world. Every major bond market, well, nobody talks about 2023 in the banking sector. SVB is forgotten history. The entire global bond market has been trading like the 2023 crisis was a big deal, and it remains a big deal. And now we're starting to see some glimpses about why the markets have taken that position. The combination of a forgot how to grow environment getting worse with all of that stupid stuff that started to be mainstream topics several years ago. These are long run processes. But what has everybody sort of a buzz in the short run is the last couple of days, the Federal Reserve has seen activity at its repo facility. Now, this part's going to be a little bit confusing thanks to the terminology. And repo terminology is confusing to most people to begin with, and it is doubly confusing when it's used in the in the context of the Federal Reserve. And what you have been hearing about the last several years, going back to 2020, is what the Federal Reserve calls its reverse repo program. That's not the one we're going to talk about here. The reverse repo program is the Federal Reserve borrowing cash from the marketplace. It's not really borrowing cash. It is taking bank reserves back from the banking sector and locking them away. So in effect, it looks like the Federal Reserve is engaged in a repo transaction to borrow cash from the marketplace. It's called a reverse repo, even though it's a repo for the Fed, is because it's labeled from the perspective of the counterparties outside the Fed. So when the counterparties outside the Fed are lending that cash to the Federal Reserve Bank of New York, they're in effect doing a reverse repo. And the point there is to take quote unquote excess reserves from the marketplace, lock them away at the Fed because they might be inflationary or any number of things. Really, the idea here is to make sure the federal funds rate doesn't fall below the Fed's target range. But that's not the repo that we're talking about. That's not the repo I'm showing you here. This is the repo facility that was largely instituted in 2019 in response to the repo market difficulties that showed up back then. This is the Federal Reserve lending reserves to financial counterparties. So from the Fed's perspective, it's a reverse repo, but from the counterparty's perspective, it is a repo. So this repo facility, think about it in the same way you think about the discount window or what the discount window is supposed to be. It's a collateralized lending arrangement that the Federal Reserve has available in case that there's any difficulties in private markets, like what the discount window was supposed to be, but nobody ever uses it. And as you can see here, just recently, suddenly it's been used for the first time to any significant degree since 2020, really the first time outside of the 2020 crisis at all. Now, let me zoom in here so you can really see the big deal here. Those other rises in the chart, those other big bars, those are quarter ends. I mean, they shouldn't be there to begin with, but quarter end, kind of all bets are off with quarter ends simply because, illiquidity due to window dressing. Though the timing there should have been questions about it. It already showed you that there was some illiquidity building, but quarter ends, that's one thing. Over the last couple of days, not quarter end. In fact, yesterday there was 6.6 billion, I think, pledged on MBS collateral, along with a little bit less than 2 billion in terms of U.S. Treasury collateral being posted, and there was a couple billion more the day before on what day was that? Wednesday. So here we have usage of the Federal Reserve's repo facility as a sort of cash lender, reserve lender, for the first time outside of a quarter end, which suggests that there is indeed monetary tightness going on. And what you're going to hear from the financial media, and especially central bankers, is that tightness is nothing more than the technical consequences from the Federal Reserve's quantitative tightening program, which is exactly what happened back in September and October 2019. We had a repo problem that developed not because of quantitative tightening, had nothing to do with the level of bank reserves. In fact, the Fed at the time admitted it had nothing to do with bank reserves. Jay Powell himself said so. It wasn't about the level of bank reserves. It's not about quantitative tightening, which doesn't tighten anything to begin with. It was about rising risk aversion under very similar terms that we're seeing today. We had the recession scare in the middle of 2019. Remember, the yield curve inverted for the first time since before the 2008 crisis. It was a major macroeconomic concerns that were combined with some monetary irregularities that were popping up all throughout 2019. It had nothing to do with QT and the level of bank reserves. And again, like I said, the Federal Reserve itself admitted as much because it was really about tightening among primary dealers and really money dealers more broadly around the rest of the world. It's not about reserves, it's about the circulation and the willingness of dealers to circulate, and the unwillingness of dealers to circulate not just reserves, but also ledger cash and collateral when they're facing less than ideal circumstances. When they perceive of macroeconomic conditions and monetary conditions, and those two things often go together, they perceive that there's increasing risks and dangers to both. They start to pull back on their activities. And as dealers pull back on their activities, that means less circulation of all of those monetary angles and aspects, which leads to real tightening, not the central bank policy tightening that you hear about, but real effective tightening that we've been talking about, because none of this is a surprise here at Eurodollar University, but real effective tightening in the monetary system itself. So like I said, the Fed back in 2019 admitted, at least initially, that it wasn't about bank reserves, but that's the official story that everybody's run with since then because they can't admit the actual truth, which is one reason why he did the webinar a couple of days ago, because all of this hidden truth and hidden material is hiding in plain sight once you know what to look for and how to interpret it. But even the Fed said it wasn't about bank reserves in 2019. And even though you're going to hear the same thing happen today and the next little while going forward, everybody's going to say it's QT, the Fed needs to adjust its balance sheet runoff, all of that stuff. No, it's about the stuff, the tightening and the macroeconomic conditions that we've been talking about all year. And among those monetary conditions, we've seen a macro-related rise in repo fails. Now, it's not catastrophic, it's not huge, but it's another piece of evidence that's consistent with the background into which all of these collateral questions, which are separate from what we're looking at here, from Zions and Western Alliance and Tricolor and First Brands, it fits within this overall monetary landscape that isn't getting to be increasingly tight for all of the same reasons. The same reasons that's driving repo fails higher is why now that Zions and Western Alliance and a whole bunch more are taking second looks at the collateral that they think that they have pledged for a whole bunch of otherwise riskier credit facilities with non-banks, private credit shadow banks all around the system. So at the very least, rising repo fails, not huge, not a big deal, not a massive concern, but it's another consistency alongside the timing of the rise in repo fails, which goes back to the payroll reports. And as I'll get to here in just a second, the payroll, it's not just the payroll reports, a negative payroll report, it's the labor market condition itself is the entire big thing here. It's the bright flashing warning that otherwise has gone pretty much unappreciated. Some more tightening stuff that I've been talking about really ever since April. foreign official institutions that use their reserve assets in the manner that reserve assets are intended to be used, which is they sell these assets because they're sitting there waiting to be mobilized whenever they're faced with dollar difficulties. So they have U.S. Treasuries that they leave in custody with the Federal Reserve Bank of New York that are intended to be used if these foreign official institutions run into dollar difficulties in their local area, whether it be local banks, regular banks, or non-banks, financial firms, even corporates. If these corporates are having difficulties sourcing US dollars, really Eurodollar ledger money, from the marketplace, they have the option of going to their local officials and saying, hey, we're having troubles in dollars. Can you give us some help here? And so what we see during dollar difficulties, every single time there's really acute dollar difficulties, foreign official institutions will sell their reserve assets and use those proceeds to help out with the dollar shortage. Now, what you would hear in the mainstream, assuming anybody in the mainstream even knows this exists, what they would say is, oh, this is just more sell America. But like I said, you can validate and correlate the activity in reserve assets with troubles and shortages and difficulties and illiquidity in the reserve currency system. And over the last several months, going back to April, the amount of reserves that have been used is enormous. Almost 200 billion since the final week in April, really the second to last week in April. Now, some of that may be that a lot of reserve managers and governments are using US dollar assets and reserve assets to help pay for tariffs. That's part of it. But the last part, really going back to July, or not going back to early August in the wake of the July payroll report, that's more monetary tightening than not. And it's very clear correlation with macroeconomic confirmation or statistics that confirm the macroeconomic background. But the amount of treasuries and the amount of reserve assets that have been used more recently is, like I said, simply enormous. And just to give you some perspective, a comparison here, back in the 2020 crisis itself, which was a substantial downturn, a substantial crisis in global Eurodollar function, about 161 billion in reserve assets that are held specifically with the Federal Reserve Bank of New York were used to help mitigate the effects of the Eurodollar crisis at the time. And just since the July payroll report came out at the early part of August, 159.7 billion in reserve assets, U.S. Treasury reserve assets have been used for whatever reasons here in August, September, now October of 2025. So what that says is not that we're seeing crisis proportions in the Eurodollar system, that level of tightening, but that it's very likely to be substantial tightening nonetheless. Whatever it is and whatever's really driving it, it is significant. That's really the point we're making, and it's another piece of background evidence that fits within the larger discussion, not just in terms of Zion's and Western Alliance, but that fits along with it. It's the entire macroeconomic and monetary background and the combination of those two things. Earlier this week, you had Jay freaking Powell basically describe the transition of the economy to the flat part of the beverage curve. Now, why is that important? It's important because up until recently, all of these credit providers, especially shadow credit providers, were absolutely convinced they didn't need to be, they'd be all over their details and, dotting all the I's and crossing all the T's and verifying the collateral because labor market's just fine. We don't have to worry. There's no risk to undertaking risky activities. Suddenly, when even Jay Powell was talking about the transition to the beverage curve and that rising unemployment's going to go up, everything changes. This is the flashing inflection point. This is the point at which you say, uh-oh, everything that I thought of just for the last several years up until now, throw that out the window because rising unemployment, just the potential for rising unemployment means that consumers as borrowers are more likely to default or go into delinquency and then maybe even default on their loans. And beyond consumers and consumer debt, smaller and medium-sized companies, if they're experiencing business difficulties to the point that they're the ones that are laying off workers, what does that say about their ability to continue to service their debt? They start to look more like first brands, and not only do they look more like first brands in the respect of having monetary and liquidity and solvency difficulties, they might actually start to, that survival instinct kicks in, and maybe they start to use collateral in a way that they weren't supposed to. So the transition to the flat part of the beverage curve, and even the official recognition of the transition to the flat part of the beverage curve, is an enormous deal. It's an enormous deal in the economy. Losing jobs is never good, but it's also an enormous deal in these credit market situations as well. That's where a lot of this, and that's why a lot of these monetary tightening signals I just went over timed to the payroll reports, because it was more confirmation, and it was powerful mainstream confirmation that everybody recognizes of exactly that, the transition to the flat part of the beverage curve. And even if we're just starting to transition to the flat part of the beverage curve, nobody's going to sit around waiting for it to actually take place. You're going to start putting all your ducks in a row, trying to line up that row of ducks toward the exit before you actually ever get to the confirmation. So again, there is a consistency here from Zion's and Western Alliance all the way through Tricolor and First Brands to foreigners using the reserve assets to what we're seeing in the marketplaces I'll get to in just a second here, the knee-jerk reaction, the anxiety and nervousness, the appeal of gold. It's all one thing. It's all the Eurodollar perspective on the same transition from forgot how to hire to remember how to fire, from forgot how to grow to remember how to recession, and however you want to characterize it, it is an inflection point that goes for a lot more than just the macroeconomy. More tightening signals, as I've been pointing out, the US dollar exchange value. No, the dollar is not crashing. No, there was no sell America in the dollar. Even the euro is now slightly weaker against the US dollar, which means DXY is slightly stronger. There is no sell America. There never was. All there ever was massive deflationary conditions back in late last year when it first developed on through really March and April of this year, which is consistent with the background that we found ourselves in. And then it backed off. With the tariff delays and the political announcements, it seemed like, okay, maybe the world escaped without suffering massive amounts of macroeconomic and monetary damage. Okay, fine, great. But after that, especially during the summertime, while the stock market continued to re-risk, the entire monetary system started to get more and more confirmation that maybe the macroeconomic climate is heading toward the flat part of the beverage curve in the US and in other places beside, like China, as I just talked about in our deep dive analysis. There's a flat beverage developing in China as well. Any number of risks out there that validated why we're seeing more deflationary signals from the US dollar exchange value, even as the mainstream media continues to talk about crashing dollar or cryptocurrency. Can't get enough of the idea of US dollar debasement. It's not happening. Cryptocurrency, especially Bitcoiners, are simply trying to justify why Bitcoin goes up like a NASDAQ stock and trying to make it about the US dollar when the two things have nothing to do with each other. In fact, the dollar is doing the opposite of what most people say because it's consistent with all the tightening that we just talked about in all these various angles. Anxiety among money dealers providing US dollars to the rest of the world, which means they're charging more to access US dollars, which is a higher US dollar exchange value. And it's not just a couple of currencies. We see synchronized behavior of currencies in all these different places. Very critical signal that goes along with Eurodollar tightening that we're seeing above and beyond what's going on with the collateral questions in Zion's and Western Alliance. Treasury market responded to yesterday's news. The two-year Treasury fell to, 3.41%, at least according to the Treasury's calculation of the yield. That's a new multi-year low there. Not surprisingly, as you can see, despite the idea of Treasury market rejection, the two-year Treasury has been almost, not steadily, but it's a clear enough trend lower going all the way back to February. So all the stuff that's happened over the last seven months, none of it has been true. The two-year Treasury continues to move lower, which is consistent with the aftermath and everything we're seeing across the macroeconomy as well as the monetary marketplace. The 10-year Treasury slipped below 4% yesterday. Again, things have turned around a little bit today, a little bit of ease that it was, but still the violent knee-jerk reaction does describe really well the anxiety that everybody's fearing, everybody's afraid of, the cockroaches that Jamie Dimon was talking about. People really aren't surprised about it. So you had the 10-year U.S. Treasury slip below 4%. In fact, it was down to 397, which is tied April for the lowest since last September and into October. So even long-term Treasuries fits with the bull steepening process, and bull steepening is consistent with monetary tightening, and more so the background consequences to monetary tightening in all of these various different forms. So you see that across the bond markets. Gold was a big one yesterday. At one point, gold was up about $120 per ounce. It has backed off today. In fact, I think it was down about $70-some before I started talking to you here, or before I started the first video, not realizing the audio had cut out on me. But gold was way up. It's back down. It's retraced a little bit here in the short run, but it's another example of This isn't just about a couple of regional banks and some relatively small losses that they might have to take. It's about the overall wider implications of everything we keep seeing, starting with the macroeconomic background, the transition, more confirmation of the transition to the flat part of the beverage curve, what that will mean, what that has already meant as far as risk aversion in the monetary system, therefore Eurodollar tightening, leading to now we're seeing collateral questions among all of these private credit and shadow bank arrangements that just make everything that much more anxiety riddled. So that's why we had such a major reaction yesterday to otherwise what would have been essentially nothing, just minor news of a couple of banks and some losses. $50 million in losses for Zions is what they were talking about. Drop in the bucket. But it's not about the one bank nor the one loss. It's about the consistency with everything else. People can start to see that there is something to be concerned about here, even if we don't know exactly what the proportions might end up being. We're no longer able to say, well, we'll just look away. Jay Powell says everything's fine. Even Jay Powell says maybe everything is not fine. So all of the bad behavior that everybody overlooked for the last several years, suddenly they now have to take a second look. And when they are taking a second look, they are not liking what they're finding. Of course, as I mentioned, for Eurodollar University, none of this is surprising. The markets have been warning about this for years, and they've been warning about this more confident. I mean, just look at the 2-year Treasury. Everybody missed a signal in the 2-year Treasury because you're listening to social media and financial media and Jay Powell and central bankers, not the actual marketplace. The hidden truths that we talked about on the webinar are not really hidden. They're hiding right there in plain sight. The problem is everybody says something else because everybody says something else. And it's given to them by a bunch of people, central bankers and economists, who don't know the first thing about the economy, they don't know anything about the monetary system, and they have every incentive to either misinform you or outright lie to your face. That's why Eurodollar University exists. That's why we do these webinars. That's why I'm here on YouTube, to fill in all of these gaps, to try to give you a sense of the hidden truth, to tell you where to look and what to do about it, what it actually means. So we did the webinar. There's a replay of the webinar that's available. There'll be a link in the description for it. I highly recommend that you check that out to start to get a sense of what exactly I mean by the hidden truths in these financial and really monetary signals, whether it's interest rates or even beyond. I mean, Contango, WTI Contango showed up this week. Didn't even get a chance to talk about that here, though I did a couple days ago. There's all of these signals that everybody misses because they're listening to the financial media or Mr. Powell or whoever else seems to look like they know what they're talking about, or whatever authority that they present. With that webinar, we're offering, I've been convinced to extend the webinar offer a little bit, a couple more days. We're offering basically the entire package of Eurodollar University. Again, our mission here is to give you as much information as we possibly can, not just information, but to tell you what it really means, what information you really need to be looking at, how to interpret it, and moving forward, what it actually means. And I'll also give you some of my own interpretations and opinions about what I think it means moving forward as well. But really, it's about filling in all of these massive gaps that are left behind by economics and central bankers to start to make sense. And not just make sense of the world as it continues to develop, but also be confident that you're making sense of the world, even because you have to remember, this stuff flies in the face of what everybody else says. You can tune out all of that noise, and you can be confident about tuning out all that noise because you know what the markets are saying. You know what these signals mean. You know where they're coming from. That's what I do. That's what I spend a lot of time every day doing, is to try to give you all of that information to fill in all of those holes. There's the deep dive analysis, which is, as the name implies, trust me, a very deep dive analysis that we do every single day. The daily briefing that tells you what's happening, the major news in the macroeconomy along with the marketplace. There are classroom videos to give you a sense of the background. How did it get to be this way? What is Eurodollar money? Where did all this stuff come from? Basics videos, these concepts that we went over here. QT, there is a basics video that describes what QT really is. I did a 4-part basics series on interest rate swaps. What are interest rate swaps? Why are they so powerful? And why is the information otherwise hidden from interest rate swaps so powerful as well? There's archives of presentations. I do a live Q&A plus a pre-recorded Q&A. And on and on and on it goes. All of this information so that you can be confident that what you're seeing, despite what everyone says, we don't care what everyone says. That's all just noise. You can be confident in the decisions that you're going to have to make, even if they fly in the face of the mainstream tide. The tide is always going in the wrong direction. So the webinar offer tons of value in all of Eurodollar University subscriptions. Just use the code that's on the screen here at our website address that's also on the screen. The offer is $1,200 per year for everything that Eurodollar University offers, from the deep dive analysis on down, but it's a limited time only, so make sure you do that pretty soon. And there is a 100% money back guarantee, 14 days. Test out the deep dive analysis, read a couple of those, watch some classroom videos, join one of the live Q&As, any number of things. Test it out for the next 14 days. If you're not satisfied, I mean, I'm pretty sure you're going to be satisfied, but if you're not satisfied, 100% money back guarantee, no questions asked. Just send me an email that says, I want my money back. I'll make sure that you get it. But you're going to see what I'm talking about here, the hidden truth behind all of these signals. Understand where to get them, what they mean, and how they fit into the overall world so that you can tune out all of this friggin' noise and make informed decisions. So sorry about the earlier technical difficulties. I've actually had to do this presentation twice. Sorry about the audio difficulties before. Thanks for joining me. I'll see you all again relatively soon. Take care.